Hi everybody, it's Damon with ChappelWood Financial again, and back on April 10th, I sent out a little message, a video message to you that mentioned it could be possible for the stock market to continue going up even as the economy slips into recession due to the COVID-19 virus. There was a lot of hope, a lot of optimism that we were going to develop a vaccine or that we were going to at least be on the road to that. There was hope that the economy would or eventually begin to open up. Right now, the second quarter is in the positive in terms of market growth. Meanwhile, the economy continues to struggle. The first quarter, we saw economic contraction. I guarantee you in the second quarter, we're going to see even more economic contraction. In fact, we're going to see economic contraction on a scale that we haven't seen since the Great Depression. So what does that mean? Well, it means we're going to have 2 consecutive quarters of economic contraction, and that equals a recession, an official recession. Now I'm back to tell you that this relationship of economic decline and market recovery can't last forever. And here's what we believe at this time. We believe that the market is in for another decline. Now, is it going to be as bad as it was in March of this year? We don't know. Okay, we don't know if it's going to be that bad or not. But the point is, we do believe that right now it's a little bit of a false positive, kind of a fake out. When the second quarter numbers come out for the economy, it's going to be a shock to most people who aren't paying attention to what's going on. Things are starting to open up. So in a lot of people's minds, they see the store across the street from their house is open, and in their minds, the economy is back. The economy's not back yet. In fact, it's probably going to take about a year for the economy to get back to where it was. That doesn't mean it's going to take that long for the market to recover, but what we want to prepare you for in the third quarter is another potential dip in the market, because the second quarter economic numbers will come out and it will scare the living daylights out of a lot of people. If it does dip, it will most likely recover, and right now we're expecting by the fourth quarter the market to recover pretty strongly. But just understand that there likely will be at least one more dip. So what does that mean? Well, for us it means we've already been positioning our clients for this possibility. I mean, early at the beginning of the year, in January even, we were beginning to divest ourselves of stocks and industries that are going to be most hurt by the virus. And that was before it even hit the United States. We were decreasing exposure to airlines, cruise lines, hotels, basically anything in the tourism and recreation and entertainment industry. Certain consumer discretionary retail areas we were getting rid of, and we were increasing exposure to healthcare, technology, and consumer staples, defensive stocks that continue to do well even in periods of volatility. On the bond side, we were reducing the term, the length that we hold a bond from medium term to very short term. You do that in situations where you have interest rate volatility, and the shorter the term of the bond, the less susceptible it is to market forces like interest rates. And we've also been raising up our cash levels. We've got far more cash now, in some cases 10 to 20% of our clients' portfolios in cash, because we are waiting for a buying opportunity. The market is overpriced right now. The price of stocks relative to their earnings, there's a pretty big gap there. We usually like to see it more here. Well, right now it's here, so the stock market is very overpriced. So that's why we have a lot of cash right now, and we're waiting for an opportunity, and there just aren't a lot of opportunities out there because the market is so overpriced. So anyway, just wanted to give you that insight, what we've been sharing with our clients here as we do our second quarter strategy reviews, and what you might expect for the rest of the year. Of course, you should never invest based on one video. You should always work with your advisor. If you don't have an advisor, give us a call here at ChappelWood Financial at 405-348-0909. We'd be happy to speak with you. If you'd like to send us an email us at office@chappelwood.com. We'll certainly get back to you. Be sure to check out our YouTube channel, subscribe here on YouTube, and check out our podcast at chappelwood.com. And make sure you subscribe to all of the wonderful, great information that we provide to our clients and our radio show listeners and followers every week. Thanks so much for watching. See you next time.